uh, forward rate agreements. This is again type of forward contract, as the name implies, forward. So it's a forward contract. When we say forward rate agreements, the underline here is interest rates. So don't get confused with the forward exchange rate and forward rate. What is forward exchange rate? What is the forward exchange rate?
The rate at which two currencies are traded in a future date. Right?
Yes, that is the exchange rate that you agree to exchange two currencies on a future date. What does it mean by future date? Beyond spot date. So you can, or you can say other than spot date. So that's the basic concept of forward exchange rate. So sometimes in the context of FX, we may say forward rate, but don't get confused with that forward rate and this. Whenever we say forward rate agreements, especially, or with respect to interest, it is referred here. What would be the interest rate on a future date for a period starting from that date? That is forward rate agreements. Sorry, forward rate. So agreements are contracts on the future interest rates. So again, it's most of these are OTC transactions. So that's why it says agreement in respect of forward interest rates. I'll explain what does it mean by forward interest rates between two parties. So basically, these are OTC transaction. Why do we know? Why do we need this forward interest rates or the forward rate agreements to protect against any future interest rates movements? This is again another instrument that you can use to hedge your interest rate risk. Even the interest rate swaps we can use, options, call options, put options we can use to hedge or protect your interest rate risk. This is another instrument that we can use. So what does it do? It fixes the interest rates in advance. You fix the interest rate applicable for a future period. It's like this. If I ask what is the three interest rates, say 3 months interest rates today, what is the 3 month interest rate today? What is 3-month interest rates in Sri Lanka? Nobody knows.
$3.25.
3.25. Starting from today for a 3 months period, 3.25. So this is the current interest rate, 3 months interest rate. Starting from today, that means if you place a deposit or if you borrow for a 3-month period from today, this will be the applicable interest rate. Okay. What would be the okay? This is 6 months. This is 6 months from today. So what's the time period in between this? What's the time period in between this?
Another 3 months.
Another 3 months. Okay. Now, if I ask you, what would be the interest rate for a 3 months period beginning after 3 months from today?
It depends with that market situation, sir.
Okay. Yes. So what I'm asking, what would be the interest rate for this period? What would be the interest for this 3 months period? 3-month interest rate starting on 3 months from today. So that is we call the forward rate.
Right.
So you start counting dates starting from a future date, not today. So 3 months period starting from 3 months. It can be, if I put 9 months here, what does it mean? From this date to this date, there are 6 months. What would be the interest rate for a 6-month period beginning after 3 months? What would be the interest rate for this whole 6-month period? That is also a forward rate. It can be 3-month interest rates beginning after 6 months from today. What would be the interest rate applicable for this 3 months period? You can fix that rate today. No need to wait until you come to this date to fix the interest rate for the next 3 months. Or you don't wait till 6 months to fix the interest rate for a future 3-month period. We fix that interest rate today. then we call those interest rates as forward rates. Is that clear? Is it clear? So this is about like time travel. You are living today, but you think about the future. You go to the future date and assume that's the starting point and move forward again. Even though you are here, you jump here, then lend or borrow for another 3 months period. Then what is the interest rate? Is it clear? You have to understand this first before we go into any calculation or discuss how do we use this product. First thing, you have to understand this concept and the time frames. Is it clear? So do I have
Yes,
to
sir.
explain? It's clear. What about others? I can hear only one or two voices.
Yeah, it's clear, sir.
Yes, sir.
Okay, then I'll move to the. So effectively, what do you do? Fix the interest rate for that period. Say after 3 months, say this is August. After 3 months means this is November. So another 6 months means this is sorry 6 months. It is May next year.
May.
May 2022. Okay. You know, you want to borrow in November 2021 for a 6 month period. That means you can pay it back in May 2022. But you don't want to wait until this time to fix the interest rate for that borrowing. You want to fix that interest rate today in August. That's all about this product. You fix the interest rate for a borrowing or a lending starting in November and for a 6 month period. That means starting in November and maturing in next May. 6 month period starting from November, but you are in August. You fix the interest rate for this period. That's all about this product. It can be a lending or it can be a borrowing. So therefore, since you can fix the interest rate for a future period, beginning on a future date, you can fix the interest rate for a future period beginning from future date. You can have your V1 the interest rate and do a transaction. So that's why it says it enables a borrower or lender to take a V1 whether rates are going rising or falling. If you think interest rate will go up in the future, then you can act today without waiting until such time. However, if say assume for this 6-month period from November to May 22, you fix the interest rate as at 4%. And definitely you need to think about a principal amount, P. So then after 6-month period, you have to pay interest or receive interest at 4% on this principal amount. But this product, it doesn't settle in that way. You don't pay the whole interest amount on the maturity date. Instead, what it does, it calculates the difference between the actual interest rate applicable for this period, because once you move into this November, you know what is the actual interest rate real or the actual interest rate prevail at that time for the next 3 months period. It may be 3.8% or 4.5% or something like that. So this is the actual interest rate. This is the forward interest rate that you agree. So in this product, what do we do? We again take the difference of this fixed rate, we call this as the fixed rate, and the actual rate, then calculate the amount based on the principal amount or interest amount based on the principal amount, and make the payment. Whoever the party who has the loss, the losing party pays it to the gaining party. So that's what it says here. The FRA pays out the interest rate difference. You don't pay the full interest or you don't receive the full interest. It is a difference between the fixed rate, that means the agreed rate, and the really applicable interest rate for that period. Again, it's not just simple difference, and you don't wait until this date to make the payment. You make the payment on this date itself. So we'll come to that. How do we decide that figure?
So, excuse me, I have a question. In
Yes.
your example, 3.8 is for the 6 months period interest or 3 months period interest? 3.8.
6 months, because in that example I consider this 6-month period, November to May. So this 3.8 is the whole 6-month interest. When we actually reach November, then we know what is the interest rate for the next 6-month period. That actual rate is 3.8, but we don't know that one before we reach this November. Yes. There's another question for comment.
So the net amount would be settled on the three or the end of the maturity.
No, it will settle on this start date, but it's not exactly the net amount. Again, we can, so because you get the net amount only on this date, because you are accruing interest from this date from November to May. So you should pay the net amount only on the maturity date. But in this product, how does it work? Indeed, we calculate the present value of that net amount, discounting back it for a 6-month period at this actual rate, and we make the payment at the beginning. So that's how we do it. We'll discuss that in the next few slides. Remember, however, the settlement take place here. You don't wait until maturity. You don't wait until maturity. So you settle the transaction on this date based on the interest rate differentials. Clear?
Yes, sir.
So to fix this, okay, even I asked the question, what is the interest rate for the 3 months? What is the 3-month interest rates as at today? Someone said 3.25. I didn't ask what is this rate, but if I am right, I would say something at least 5.2, close to something. This would be the treasury bill rate. This may be the fixed deposit rate that you refer. So even for the same tenor, there can be different interest rates. Treasury bill rate, deposit rates, lending rates, things like that. AWPLR, things like that. So therefore, when you enter into agreement, you should be clear about what is the reference rate that you are going to use. In the international market, so far, the LIBOR is the benchmark rate, but as I mentioned now a few times, this will be replaced with some other interest rate. So there should be the key message is there should be a benchmark rate agreed upon. So you consider that rate when it comes to the time to accrue interest. Otherwise, there will be a confusion. Someone say no interest rate, 3 months interest rate is 3.25. I can say no, 3-month interest rate is 5.2. Both are correct. This is deposit rate. This is treasury bill rate. If I want to borrow for 3 months, someone would say it is 8%. So that is also true. So in the market, there can be different interest rates even for the same tenor. So therefore, you have to be clear what is the exact rate that you are referring to. We call that the benchmark rate. There should be a benchmark rate assigned in the product. And in this example, I said you want to borrow money for a 6-month period in November. But in this forward rate agreement, you are not going to borrow through this agreement, or you are not going to lend. So therefore, you don't exchange any principal amounts under this forward rate agreement. You don't exchange any principal amount. So this principal amount, it is just a notional amount which we use to calculate the cash flows. We don't exchange the principal. So effectively, you are not borrowing or you are not lending. Is it clear? So no principal amount actually borrowed or lent. So then say, as I explained, you need money, say 1 million in November. So then how do you get that? On this date, you go to the market, borrow from the market at the prevailing rate. That's what you do. You go to the market, find a lender and borrow from that lender at this market rate. Nothing to do with this forward rate agreement. Then few words that you have to remember. Now, in this case, basically what happens, one party agrees to pay this fixed rate, agrees to pay that fixed rate, what you fixed today, and meantime agrees to receive this, whatever the rate available in that time. So we can consider it as a floating rate. So that's what happened. That's why you exchange the or calculate the difference. While you are paying, you receive this. So the difference you pay. So the party going long, that means buyer of the FRA, we call it, you are buying a forward rate agreement or you sell a forward rate agreement. When you say you are long or you are a buyer of the FRA, what does it mean? You agree to pay the fixed rate and receive the floating rate. So that's why it says is essentially long the rate. Even last week, if you can remember, I mentioned that whenever you say you buy a IRS, what does it mean? You are supposed to receive the floating rate, unknown variable. That's what we call we are going long. The same concept is applicable here. Whenever you say you go long in a FRA, that means you agree to pay a fixed rate and receive the floating rate. So the opposite is true then for a short party or the seller. Seller agrees to pay the floating rate and receive the fixed rate. So long party what does it receive floating and pay fixed. What would happen in the future if interest rate goes up? Who takes the benefit? Long party or short party? In the future, interest rate goes up.
So the long party gets the advantage, right?
Yes, long party gets the advantage because he will receive the increased or higher interest rate. So this party gets the benefit. If interest rate goes down, then the short party agrees to pay the floating rate. That means lower interest rate. In that instance, short party makes the profit. Is it clear? So it is given here. Long party will benefit if rates increase. Short party will benefit if rates decrease because as a buyer, you receive the floating rate. If the interest rate goes up, that floating rate would be at a higher level. As a short party, you pay the floating rate. When the interest rate goes down, you pay a lesser amount. So in summary, this is what would happen. As a buyer of a FRA, party pays the fixed rate. and receive the floating rate and get the benefit if interest rate increases. As a seller pays the floating rate and receive the fixed rate, so therefore get the benefit if interest rate decreases. So therefore we can consider it as an effectively buy or sell an interest rate. That interest rate we fix today, but will be effective from a future date. And there will be a linked benchmark rate. So starting on agreed future date for an agreed future period based on agreed principal amount or the notional amount. But remember, we don't exchange that principal amount under the forward rate agreement. So this is the thing I explained. The price settle on the date when the FRA period starts. What is this FRA period is? This is 3, this is 9. Remember, we count time always with reference to or starting from today. Don't put this as 6. From today, 3 months. From today, 9 months. Then this period is 6 months. That's true. But we start or we count dates for the time with reference to today. So what I wanted to mention, okay, the FRA period. This is the FRA period, 6 months, and we settle the transaction here. That's what we do. So this is the FRA period. So therefore, the settlement amount is subject to discount. We discount it. I'll explain what is that, why do we need to discount, how do we do that. So this 6 month is the FRA period. This is the beginning of the FRA period, but this is the beginning of the agreement contract. Not this date. This is the beginning of the FRA period. We settle the transaction on this date. We don't wait until the maturity. Okay, this is an example. The company knows that in 1 month's time, it will need to borrow 15 euros million a period for 6 months. The company treasury is concerned that, okay, now this company knows they want to borrow. What is the risk? That you know you want to borrow on a future date. What is the risk?
Future interest rates.
Future interest rate. Yes. What exactly? There will be a future interest rate. Whether it will go up or go down. Which one?
So go up.
If you think it will go up, then that's the risk as a borrower. Or if the future interest rate is low compared to today, then you can borrow at a cheaper rate. So the risk for the borrower is future increased interest rates. in the future. So that's the same, exactly the same concern that Treasury has. Treasury is concerned the interest rate might rise in the next month. So if you wait until 1 month period, if the interest rate goes up, you have to borrow at a higher rate. What do? He wants to fix the future borrowing rate today without waiting 1 month period. He preferred to today. What's the way? Since he's a borrower and he want to protect from the increase in interest rate, which one he should do based on this? Should he buy a FRA or sell a FRA? You are a borrower, you think interest rate is going to go up. Will you buy a FRA or will you sell a FRA? Buy a FRA or sell a FRA? You are a borrower, remember that. You buy.
It should be a buyer FRA.
Yes, it's a buy. Why? You get the benefit if interest rate increases. So as a borrower, that's what you need. So you buy a FRA. So that's what he has done. He enters into a forward trade agreement whereby he buys an FRA, then for which for a 6-month period, start in 1 month's time. That you have to be mentioned. You have to be clear on that. For a 6-month period, but start in 1 month's time. So the fixed rate is 5.4. That means the treasurer has to pay 5.4 on 15 million for a 6-month period, starting in 1 month time. He will receive interest on 15 million based on the 6-month interest rate prevail after 1 month's time. If that market rate is higher than this fixed rate, the treasurer will get that cash flow. If it is lower than that, the treasurer has to pay that. The advantage is he knows what is interest rate. I said, he knows it today. No need to wait until for another 1 month period. So assume that he enters into this transaction. So he buy a FRA at 5.4%. Now he has to pay 5.4%. So now time moves. We are here. Now we have to fix what would be the applicable rate for this uh, 6-month period. Now time has passed. We are here now after 1 month. That means September. What is the LIBOR? Then that will be used to see whether the treasurer or the other party is making money or the cash flows. So assume, sorry, this is the summary. Notional amount is 15 million, required to borrow 1 month, in 1 month for a 6-month period. Fixed rate is 5.4. The benchmark rate is 6-month LIBOR. Why this 6-month LIBOR? Because it's your requirement is for a 6-month period. So it should match with this. Then we'll see what would happen. So remember, the FRA period begins in 1 month from today. T equals 0, T equals 1, T equals 7. So the FRA period begins here. But the forward rate agreement ends in 7 months from today. So the total period is 7 months. So there's a notation that we write it in a short form without saying like this 1 month interest rate, 6 month interest rate in 1 month's time. Without saying that, we represent everything in a very short form in this way. 1 versus 7, no, 1 into 7. What does it mean? In 1 month for a 6 month period. The total period is 7 months. Is it clear? This 1 by 7 notification, what is it? When do you start the FRA period and when do you end it from today? 1 into 7 means you start FRA in 1 month period for a 7 months time. So what does it mean by 3 into 6? If you say FRA 3 into 6 FRA, what does it mean?
Starting from 3
3
months.
months.
Starting 3 months for another 3 month period. 3 into 9. 3 into 9.
Starting 3 months for another 6 months.
Yeah, starting in 3 months for another 3 months. One into 13.
Starting in 1 month, ending in 13 months.
Yes, ending in 13 months. What does it mean? Starting from 1 month for a period of 12 months. So this part would be 12 months, 1 year. So that's how we denote this. I think it's clear. So now suppose on this date, the LIBOR is 5.55. On this date, LIBOR is 5.55. Whether the treasurer or the company makes money or lose money on this agreement, or forget about whether gain or loss, should the company pay the interest, the difference, or receive the interest? Difference.
So receive the interest.
It's receive the interest because 5.4 is the fixed rate. Now the reference rate is 5.55. That means for this 6 month period, applicable interest is 5.55%. The agreed rate is 5.4%. This is the fixed rate. This is the current rate. So the current benchmark rate is higher than the fixed rate. So as the FRA buyer, you receive this, you pay this. So therefore, the difference will be received. So the difference between the 5.4 rate agreed and the 5.55 fixed, that will be received by the FRA buyer or paid by the FRA seller. Remember, there's no exchange in principle. But on this date, now company needs that 15 million. How that treasury is going to raise that? Forget about this FRA contract. He has to go to the market, borrow from a bank, or there may be a bank that with whom they trade, borrow that 15 million at 5.55, and there may be another margin, borrow at that rate. That's a separate transaction. In the FRA agreement, even we don't have to discuss this part. It's nothing to do with this FRA. It is his funding requirement. So now this is the summary as of this date. 6-month LIBOR is already fixed at 5.55%. Fixed rate is 5.4%. Assume there are 182 days between in that 6-month period. Now we'll try to calculate what is the payment amount or the amount that the treasurer received on this date. First thing, we calculate the okay. I'll explain it here. First thing, now we don't want to worry about the past. This is history. Now we are here. $182 days. Fixed rate is 5.4%. LIBOR is 5.55%. Principal is 15 million. Okay, now you know to calculate what would be the payment to be made here. What would be the payment to be made here at the end of that 6-month period. So on the other hand, if you assume you borrow 15 million at 5.4 and you lend that 15 million at 5.55, what is the cash flow here? You borrow at this 5.4, you lend it at 5.55. What is the cash flow here? How do you calculate it? The difference 5.55 minus 5.4 divided by 100. That's the interest rate difference on $15 million for a 182 days over 360. Correct? This is the difference between interest that you receive and interest that you pay. This is the cash flow that you expect after 6 months time. But the FRA settles on this date at the beginning itself. So therefore, what you have to do, discount this cash flow back to here. What do? You divide this everything by what? What is the denominator?
The discounting factor.
Yeah, what is the discounting factor? 1 plus. Which interest rate now we are going to use to discount?
5.5.
5.55 exactly, because that is the prevailing market rate. So you have to discount it at 5.55. 5.55 divide by 100. Not only that, this is for 182 days. I guess you can remember money market calculation. So this is what given. This is the principal amount. What is this? This is LIBOR. What is this? It's the fixed rate. What is this? Number of days divided by, or you can put it as day count convention here. Again, this is LIBOR and day count convention. So 11,064. So this is the equation. You can use this. On this date, this treasurer will receive 11,064. Yes, 11,064 euros on this date. That's how the transaction is settled. If the LIBOR was lower than the fixed rate, say 5%, still you do the same calculation. Put 5% here, 0.54 there, then you will get a negative figure. What does it mean? Treasurer has to pay that amount to the buyer of the FRA should pay that amount to the seller. Like in options, we do this, or we use this equation to calculate the net settlement amount from the buyer's point of view. If you get a negative figure, that means buyer pays. If you get a positive figure, that means buyer receives. Is it clear? Any questions? Any question? If not, we can move into the next. That means other scenario. where the LIBOR fixing was lower than the agreed for the fixed rate. 5.4 versus 5.25. So in this instance, the buyer of the FRA has to make the payment to the seller. What's the amount? Again, do the same calculation. The calculation is not given here. You can use the same equation. LIBOR is 5.25. This is 5.4. All others are same. This is also 5.5. Sorry, 5.25. Will you get the same figure? Same. This difference is 0.15. 0.15%. Even this example also, it's 0.15. This difference is 0.15. Will you get the same answer, that 11,064 here? What do you expect? Higher amount or lower amount than that? Huh?
Higher amount.
Higher amount. Why?
Denominator is less than 5.5.
Yes. The numerator amount here, it won't change. It will be same. But in the discount factor, this is low, 5.25. So the same amount you discount at the lower rate, you get a higher amount. So the interest rate low, the present value is. So if you can answer that question, that means you have understood. Oh, in the not only this, the present value and future value concept and the relationship between interest rate and present value, everything. So therefore, even though the interest rate difference for the positive side and the negative side are the same, the final outcome would not be the same. Remember that. Okay, any questions? So what ultimately it reflects, the fixing rate is 5.4. LIBOR can be 5.55 or it can be 5.25. Irrespective of these two scenarios, what is the effective rate for this company or this borrower? What is the effective rate? The effective rate is 5.4. Why? If the LIBOR is 5.55, the company receives that difference. He receives this. So he can use that receipt to pay for that borrowing. If the LIBOR is less than the fixed rate, then he has to pay. So even though he pays 5.25 on his loan, he has to pay that difference for this FRA. So effectively, the company or the borrower pays 5.4. So Now you can understand by entering into a FRA overtrade agreement, you can fix your future interest cost or the gain, irrespective of the market interest rate prevail at that time. That's the usage of this overtrade agreement. You can use this to speculate. That's true. And there can be opportunities of arbitrage if the market interest rate and the fixed rate implied in a overtrade agreement is not again matched, then there will be an arbitrage. You can explore that as well. But basically, the basic use of it is to fix your future interest rates.
Excuse me, Siddhartha.
Yes.
For the discounting equation, we divide by 360 since this is given in pounds.
Is this in pounds or euros?
Sorry, euro. Sorry.
Euros, yes. If it is pounds, 365.
Since it's in euro or dollars, we use 360.
Dollars, we use 360, yes. That's the market convention. If it is Sri Lankan rupee,
365, no?
365.
This does this get? This number of days will it change to 366 if we are going for leap years and so forth, or it will be just common as 365 in general terms?
365, no? Because in money market, what we use
Short term.
actual
365.
365. If we use actual, then this becomes 366. So don't forget that basics.
So,
that's the thing. With the time, you are going to forget this basic. You just use 365 or 360 without any idea what's going behind. Then suddenly you come up with that question. Now this is leap year, what to do? Then you get confused. Then go back to the basics and think what to do. Don't be panic. But you have to do the basics correct. You can stay without panicking and not doing the basics properly. That's a different thing. That's good that you don't panic, but that allows or should allow you to follow the basics properly. Anything else? So again, the same FRA period, we can consider them as or sometimes we call it the calculation period. And that calculation period divided by the number of days per year, we call it day count fraction. So in this example or equation, this part, we can say this is the day count fraction. Days in FRA period is the calculation period. So this is the answer for your question. Just to remind you what. Okay, any question? Any question? I don't have any questions. May I ask a question? How do you decide this rate? So you decide that at time 0 today. You decide the 6-month interest rate starting from 1 month today. How do you do this? That's what we are going to discuss next. Again, I'll explain it on this. So whatever period, I put it as T1 and T2. This is T equals 0. Okay. As at today, you know the interest rate structure in the market. That means for any maturity, you know what is the interest rate. What is the interest rate? What is the 1 month interest? What is the 2 month interest? 6 months, 3 months, 1 year. You know from today, as at today, what are the interest rates? You know that. So therefore, in this for a FRA T1 into T2. Clear? The FRA for a T1 into T2. What should be the fixed rate? That's the question. How do you fix the interest rate for this period? I denote it as F. How are we going to fix that rate? What are the things that we know? We know the interest rate for this R T1. Correct? Do you know that interest rate? As at today, you know what would be the 3-month interest or the 1 month interest, whatever applicable. Not only that, we know the interest for this period R E2. Say this is the 3-month interest. This is 9-month interest. Then the whole together it will be 1 year. Something like that. Or in our example, previous example, 1 month and 7 months. We know that those interest rates. Now, but the question here is, how do we calculate this rate F? Again, this is sort of arbitrage. So indeed, what do we do? So what we assume, say if you invest 1 rupee or $1 here for a 1 month or whatever this T1 period, then you take that proceedings on the maturity and invest that for another 6 months or whatever that remaining period. The end figure, whatever cash flow that you get here, it should be same as you invest that $1 for the total period. Whether you roll over and get the cash flow or whether you invest for the whole period advance, both cash flows should be the same. There shouldn't be any difference. On that basis, we can calculate this F. Is it clear? You roll over, what is the cash flow that you receive? You invest straight away for the whole period, what is the cash flow that you receive? So cash flow 1 should be equals to CF. Based on this concept, we can calculate the forward rate. Is it clear? Any questions on this?
So can you explain that again?
Yes. Say it's like, okay, I'll put it into numbers. Assume this is 3 months and this is 9 months. From the origin, from today, 3 months and 9 months. We are going to price or find out the interest rate, fixed interest rate for a FRA, that is 3 into 9. That means 6-month interest rate beginning from 3 months today. What would be the applicable interest rate? So to do that, the assumption here is you invest some amount for a 3 month period, you get the maturity proceed, then you invest that maturity proceed for another 6 month period. You get a cash flow. That should be same as the maturity proceeds that you get if you invest the same principal amount at time 0 for the whole period. That means for the whole 9 month period. So that cash flows, there shouldn't be a difference. Based on that, we derive this interest rate. So that means you invest at RT1 for the first period, then you invest the proceeds of the previous investment at the rate of F for the next period. Whatever the cash flow you get should be same as if you invest your principal at RT2 for the whole period. That's the concept. Is it clear?
Yes, sir, it's clear now.
Hold together, assume hold together 7 month period. You invest for a 1 month period, take the proceeds, invest for another 6 month period. What do you get at the end of 7th month? It should be same as if you invest your principal for a 7 month period straight away. That's the concept. So, but this is something we don't know. But we don't know, we know the equations, and by equating these two, we can derive an equation for F. So that's what we are going to do here. How to derive the fixed rate? We call it forward rate or the forward rate. This is the final result. If you do that calculation, this is what you get in FRA. RFRA. That means for the FRA period, applicable interest rate that equals to the whole period interest rates into the number of days minus the first period interest rate into the number of days divided by number of days in the FRA period or the calculation period times 1 plus discount factor here. This is indeed the discount factor applicable for this. If you want to see how do we get it, to make it easy, I will put it as R1 N1. That means R1 is the interest rate for the first period, N1 is the number of days. Then RF, NF for the whole period, R2 N2. Now tell me, if you invest 1 rupee for the first period, what do you get at the end? What do you get here? If you invest 1 rupee at R1 for N1 number of days, what do you get at the end? If you invest 1 rupee here for a N1 number of days, interest rate is R1. What is the total amount that you receive on maturity? If I put numbers, so if you invest 1 rupee at 5% for 182 days, what do you get at the end of 182 days? Can someone tell me the answer? This is nothing to do with FRA. This is just interest calculation.
So 1 rupee into interest rate, 1 plus interest rate into the
1 plus interest rate into
divided by 100 into
divide by 100. Okay, we'll forget that 100 here. Assume that this decimal place in decimals. Okay, multiplied by.
180.
So 180 means whatever the number of days, divide by again 365 or 360 or whatever. If you invest 1 rupee today for N1 number of days at the interest rate of R1, this is what you get at the end. Now you invest this total amount for another period NF at the rate of RF. Then what do you get here? Now this is the principal amount that you invest. What do you get at the end?
That amount into RF.
This amount into
RF
RF
into NF divided by 365.
RF into NF divided by 365. Is it correct? If you multiply this amount by this, what do you get?
1 plus RF.
Only the interest. If you do this calculation, you get only the interest. But you
1
need
plus.
the total amount. It is 1 plus RN. So if you invest 1 rupee here for N1 period at R1, you use that maturity proceed, invest for another NF period at RF at the end of N1 plus NF. Or it should be equals to N1 and NF equals N2. You will get this total cash flow. Okay, now tell me, if you invest 1 rupee at R2 for N2 period, what do you get on this date? It is 1 plus R2 N2 divided by 365. So what do? You equate, make it equal both sides. Now what you don't know? Only thing that you don't know is RF. That's what you have to find out. Do some calculation. So you will end up with this. Try to find out RF in this equation. You should end up with this. Is it clear, the concept? So no need to remember this equation, but remember the concept. Then you won't forget. Is it clear? This is the fixed rate for a forward rate agreement. This is what we call price in a FRA. How do you, what does it mean by price in a FRA? Quote the fixed rate. What is the fixed rate applicable for that FRA? This is how do you do it. You can straight away use this equation or do this calculation. Either way, it's fine, but then you have to remember the equation properly. Or in this, what you have to do, remember the concept behind it. Any question? Any question? Is it clear? So now you can see the importance of remembering this. Sorry. Future value equation in money market. This is the equation we used because this is a money market calculation. How to calculate future value and present value. and compounding at different rates for different periods. So nothing new here. All these things what we have discussed, we combine 2, 3, the same concept. We applied it for 2 different scenarios. That's what we did. So that's what I said. No rocket science. The simple concepts that we have. Is there any question? So if not, this is an example. This is on sterling. 1 month rate is 5.55. The 7 month is 5.85. Then what is the pricing of FRA? 1 into 7. 1 month 31 days, 6 month 183 days. So N2 into R2 into N2 minus R1 into N1 divided by R1 into 1 plus, N2 into 1 plus R1 N1 divided by 365. So you get 5.87. So know this equation, substitute that. 6 month period, 183 days. But remember, from the beginning, there are 7 months. So 7 month, 585. So for that 7 month, number of days is the total of this 183 plus 31. Don't use 183. So the fixed rate would be 5.87 given this interest rate structure. So any questions? That's all about forward rate agreements. Any questions? Do you have any question, please?
So here N1 plus NS equals to N2, that if that is not there, it gets arbitrage opportunity.
Yes, exactly. That's the thing. If say when you calculate this rate using this equation, let me go back to the presentation. So this is the market interest rates, 5.55, 5.85. You calculate this rate 5.87. But in the market, if you can see the forward is quoted at 5.8%, there's an arbitrage opportunity. Should you buy a FRA from the market or sell a FRA in the market? This is market rate. When you calculate, the rate comes as 5.87, but in the market it is 5.8. Should you buy the FRA or sell the FRA?
Sell the
Sell. Why?
market expectation is that rates to go down.
Market expectation is rate to go down. Why do you say like that?
Market is 5.8.
Market fixed rate is 5.8. Is it correct? Now, based on the current market structure, in 1 month's time, if you want to pay for a 6 month, you have to pay 5.87. But in the market, you have to pay only 5.8. Then what do you do? Which one is cheap?
Market is cheap.
Market is cheap. So, what do you do in the cheap market?
You can borrow and
In the cheap market, what do you do? Buy or sell? You buy a FRA, because if you buy a FRA, you have to pay only 5.8, whereas you receive the LIBOR. But according to the current structure, you have to pay 5.87. So buy a FRA from the market at 5.8, then what do you do? Think about. You buy a FRA means what you have agreed to pay 5.8, what you have agreed by buying a FRA. Now you agree to pay 5.8 here. Then what do you do? For this whole period, will you borrow or lend? And what do you do for this period? What do you do for the whole period? What do you do for the short period? The applicable rate here is 5.5. Here it is 5.85. Okay, think about what to do. There's an arbitrage, obvious arbitrage, because there's a difference between market rate and the implied rate. So the market is cheap, so therefore you would buy the FRA. Then what do? That means you agreed to pay 5.8 for this period. Then should you create a liability here or asset here? Should you create a liability here or the asset here? Think about it. Any other questions? However, that's good that you remind me. If there's a market rate and the implied rate, that means there's an arbitrage opportunity. Any other question? If you don't have any questions, what's the time now? If you don't have any questions, shall we take a break here before we start the new topic? Is it okay? This is basically about structured products. The one of the structured product is collateralized debt obligations. That means basically what do? You collect debts or the pool of assets and create a security. So most of these debts are not that you can sell in the secondary market. So that's the basic idea. I'll explain that. So as it mentioned here, it's an asset-backed security, and this is a special case of that asset-backed security. When we say asset-backed security, asset can be a mortgage loan or credit card payment collection, or maybe lease or vehicle lease, or whatever the assets that have in a bank. So you know, when you give a mortgage, grant a mortgage, you can transfer that mortgage to some other party. You have to keep it in your books until maturity. So but this collateralized debt obligations gives the banks or the originator to transfer that asset to a separate entity, and based on that issue a security in the market, allowing other investors to invest in that security. Basically, so what do we do? So basically, we have a portfolio of debt as a bank. We have another entity called special purpose vehicle and investors. These are the three parties in this type of structured product. There can be some other parties, rating agencies, insurance providers, debt service or services, and likewise. But these are the three major parties. How this work is, the bank which has a debt portfolio, same sort of debt portfolio, the bank will sell it to or transfer that portfolio to another party. We call it a special purpose vehicle. It can be a sort of subsidiary of this bank. Then based on the cash flows that we can expect on this debt, pool of debts, the SPV sell securities. Securities means bonds. But when do they issue these securities? They again divide that securities into different, we call them as tranches. Not each and every security has the same characteristics. Depending on the tranche, the characteristics are different. Whatever the interest or the coupon rate is different. Maturity period may be different. The priority or seniority of the tranche would be different. So therefore, each tranche has different characteristics in terms of coupon rate, seniority, things like that. The priority that you get to receive the cash flows, things like that. And therefore, different tranches may have different credit ratings as well. That's the basic structure of a CDO. So that's why it says CDOs are split into different risk classes called tranches. So the most senior tranche is the safest tranche. So that will carry the highest rating when the risk is low. When the risk is low, what would happen to the return? Return also low. That carries maybe lower coupon rate. Then there will be junior tranches. It can be one or more than one, but with high default rates and high coupon to compensate the high risk and low price. In between that junior and senior and junior tranche, there can be another one or more tranche we call mezzanine tranche. So that's the basic idea, or in this we can say basically is senior tranche. At the end we call it junior or equity tranche, where this is supposed to absorb any or most of the losses, and this is the mezzanine tranche or the junior tranches. So this is the safest, this is the next safest, and this is the most riskier tranche. There can be more tranches, usually one equity tranche and one most senior tranche, at least 3 tranches. So investors, depending on their risk appetite, they can invest either in equity, the senior tranche, or the mezzanine tranche, or the equity tranche. But most of the time, the bank itself invest in the equity tranche to give some confidence to the investor. So because the bank is ready to absorb some or part of losses, that's what would happen. So once this happens, I'll explain the mechanism. So bank has a portfolio of debt, say mortgage loans. So then we appoint another party called servicer. The role of the servicer is to collect the monthly cash flow and deliver it to the SPV, basically to the SPV, then decide the payments to senior tranche, mezzanine tranche, and the equity tranche. The bank does not involve in that process most of the time because the servicer is supposed to do that. So they collect the payments by the borrowers and distribute it among the securities. And meantime, there can be another fund, sinking fund kind of reserve. So if there's any excess, once you pay to senior tranche, mezzanine tranche, and equity tranche, there can be a fund that you build as a cushion. If there's any default by customers and cash flow is not sufficient to pay for these investors, those who have invested in any of these tranche, then they will use this fund to fund the shortfall. But in the worst case, borrowers default, there's not enough cash flow to pay for the senior tranche and mezzanine tranche and equity tranche all together. Then they first try to pay whatever the due for the senior tranche. If there's any remaining balance, that will be used to pay for the mezzanine tranche. And after paying for the senior tranche and mezzanine tranche, still there's a balance, then it will be used to pay for the equity tranche. If the balance is or the cash flow is not enough, the equity tranche has to absorb that loss. They won't get any cash flow only, or maybe only a part of that cash flow. So likewise, equity tranche is the first tranche is going to take the loss. When the equity tranche is over, that means up to that capital, they have absorbed their loss. Then the mezzanine tranche would absorb the loss. If it is also over, then only that senior tranche will have to absorb losses or take losses. That will happen only in the extreme event. That is the basic structure. So I'll explain it. So corporate or a commercial bank, there can be different type of assets. It can be car loans, credit cards, other loans, maybe bonds or leases for different tenors. Remember, in that pool of assets, it needs not to be the same tenor. It can be in different tenors. What the bank can does, create another entity. We call it the special purpose vehicle. It can be a sort of subordinate of this entity originator, commercial bank, or it can be a completely independent entity. But most of the time, it would be a subsidiary of this corporate or the commercial bank. So why do they create this special purpose vehicle? Is to remove the risk that comes to the commercial bank or this corporate due to default of these loans. So we call it bankruptcy remote. So we transfer that risk to the SPV. So the commercial bank or this entity does not have any obligation on that ultimately. So that's have advantages and disadvantages too. So however, this is the structure. The bank creates another entity called special purpose vehicle or special purpose entity. So then what do? They transfer all assets to this special purpose vehicle. So then they transfer that assets. The special purpose vehicle has to pay for the commercial bank, provide the amount. So this commercial bank or this corporate, we call it as the originator, transfer those assets to the SPV, and SPV pays or transfer funds to the commercial bank. How this SPV create funds or generate funds? That is by issuing those assets. That's the next step. So what do? They issue, the SPV issue securities backed by those assets that they purchase. As I mentioned earlier, the securities will be or these investments will be categorized into safe investments, decent investment, and risky investments. Whatever the assets that the SPV receives, categorized into safe investment, decent investment, and risky investments. Because in this all assets, there can be different sort of borrowers depending on the tenor, depending on the product. The risk may be vary. So what the SPV does, categorize them into these categories, the assets. Then what do? They slice it to small pieces. The whole safe investments, they slice into different pieces, say 1 million each or something like that. Then they take part of the safe investment, part of the decent investment, part of the risky investments, and create different bundles. These bundles we call collateral debt obligations. Then they sell those bundles to the investors. They can buy. Again, they will categorize these bundles into whether that falls into senior tranche, mezzanine tranche, or the equity tranche. So this is the lowest, or this senior tranche carries the lowest risk, and the equity tranche carries the highest risk. And the medium risk in between senior and equity, the mezzanine tranche is there. That there can be more than 3, there can be more than 1 mezzanine tranche. That's the basic structure. So investors, depending on their risk appetite, as I mentioned earlier, they will invest in any of these tranches. So that's how special purpose vehicle or special purpose entity create or generate funds which is needed to pay for this commercial bank or the corporate when the SPV purchase all those assets. Now, what is the advantage for this commercial bank? For these loans, they have to use their funds. Not only that, depending on the risk, they have to keep capital. There's a minimum capital requirement based on the risk-weighted assets. So That's a costly affair. Once they transfer all these things, all these assets, or at least part of these assets to the SPV, they'll get their amounts that they loan to these assets or the borrowers. They'll get that capital, and they can release or get a relief from the capital requirement as well, because no longer these assets are held in the commercial banks or these banks or the corporate books. All those assets are transferred to the special purpose vehicle. So that's the advantage that the commercial bank or this originator, we call that party who originally creates these assets or grant loans, that party we call originator. That's the advantage for the originator. The risk there is whether the originator has done a proper assessment when they originally grant these loans, because knowing that they can transfer these assets to SPV, there's a moral situation. They may not do a proper analysis. So that's the risk in this product. That's one of the reason for the 2008-2009 global financial crisis. Since the investment banks can transfer their assets to SPV, they have not done the proper analysis on the borrowers. They tend to lend for the subprime borrowers, and therefore the borrowers, they had cheap funds, they borrow at cheap rate, then they start to buy real assets, houses. So then the prices started to go up. When price goes up, others tends to do the same. So that creates the bubble. That's what happened. So however, this is the structure. The originator generates assets, or that means grant loans to different sectors, and transfer those assets to the SPV. SPV bundles it and sell it to the investors. That's the first part, up to the creation of securitized product. Then what would happen? Okay, when they create this, they will say, if you remember, I mentioned that this asset can be at a different maturities. So they structure this in such a manner. So depending on these maturities, they may issue these on different maturities as well, considering the weighted average maturity of the loan portfolio. However, they should be able to serve the longest maturity as well. In some instances, say in this example, there are 30-year leases, 20-year loans or bonds, different maturities. So they may issue a 30-year CDO with a coupon payments, but say some payments like this, receipts like 5-year maturities or 10-year maturities, the SPV may reinvest it in the same sort of assets to generate another set of assets. Then use the interest rate flows to pay the coupon and to pay the principal at the end of 30 year by issuing a 30-year CDO. That can be done. So therefore, there can be different or slight different between one CDO to another CDO. There can be a CDO that you get, most of the time it's the case, you get part of the principal and the interest as well. There can be some you get only at the principal, you get at the end, things like that. Different structures can be there. But however, this is the basic structure that we are discussing here to you to get some idea how these CDOs or asset-backed securities work. So during the lifetime, so based on this bundle, there will be a cash flow. Borrowers will pay their interest and principal amounts. So the servicer will collect those and then assess, okay, we have collected this much of money now. What is the payment to be made to the equity tranche? First, make that payment to the equity tranche. Then, if there's any excess, then pay it to the mezzanine tranche. Once obligations to the senior tranche is paid off, then remaining full or goes to the mezzanine tranche. If it is fulfilled, then go to the equity tranche. That's why we call this is a waterfall structure. Like in a waterfall, from top to bottom, the cash flow will flow. Once you fill this senior tranche, pay the, say, this month 1 billion is to be paid for the senior tranche. The cash flow should be more than 1 billion. If there's more than 1 billion, first 1 billion is used to pay the senior tranche. Once it is paid, there's excess. So then the remaining balance is used to pay the mezzanine tranche. Once you paid the mezzanine tranche, say another 1 billion, make that payment. Then there's another 500,000. Use that 500,000 to pay to this equity tranche. If the cash flow is not enough to pay the equity tranche won't get anything. If the cash flow is not enough, so the cash flow is now lesser than the previous instance. It is enough only to pay the part of the mezzanine tranche. So equity tranche first absorb the loss, then the mezzanine tranche will absorb the loss. That's how the CDO works. So the risk and return for the CDO investor depends directly on how the CDO and its tranches are defined. That's why I mentioned. So how these tranches have defined. What is the senior, most senior? What is the mezzanine? If there are more than one mezzanine tranche, what is the priority? Which one gets the priority over the other? That seniority matters again. And finally, however, the equity tranche generally it's a small portion compared to the whole size of the CDO. So therefore, it's mostly depend on the how they have structured this. There will be a direct impact from this, indirect impact from this cash flow. So how the asset pool performs, whether borrowers pay their dues properly or not, that has an impact. But mostly how they have tranched this directly impacted the performance of these securities. So as I mentioned, what are the advantages that allow the originators to pass the credit risk or remove the credit risk from their balance sheet or their books to another party, which is called SPV. And even the SPV does not take that risk because SPV has passed it to the investors in the form of securities. So the issue of the CDO or the SPV that they will make a commission, or that's the income they earn, and the management fees. Then there are many other parties, those who provide insurance. To one more thing, say the pool of loans these may be individuals. The borrowers may be individuals. But when it comes to the rating of these tranches, this can be a AAA or at least AA, highly rated tranche. How can they do that? There are few things depending on how they have structured this. What are the cash flows or the priorities given, or whether they are say over collateralized. Say if the value of all the loan portfolio is 10 billion, they may issue only a 6-7 billion worth of securities. The difference is keep it as a cushion, as a over collateralized. So even some defaults occurs, it won't affect these payments. So likewise, the issuer, that means the SPV, can do some actions to reduce the risk of these tranches or the total issue and get high ratings. Not only that, there can be insurance. Those who would like to give insurance on these issues. If the borrowers won't pay, the insurer is willing to pay this. Insurance company is willing to pay that difference. So with all those things, they can issue highly rated bonds, but backed by assets created with individuals, may not be corporates. So that's how they reduce the risk. So therefore, apart from the originator, SPV, and investor, there are few other parties. One party is credit rating agency, those who give the ratings. The other one is, as I mentioned, servicer. And the other one may be insurance company. So they'll get their share or whatever the fees or commission by doing those business. So what is the advantage for the investors? So investors, they may not get a chance to invest in a mortgage, because say if I want, as an individual, as an investor, I want to get the exposure to real estate market or the mortgage. How can I do that? I cannot give a mortgage loan to another person. It would be very costly affair. But through these products, if I can buy a CDO or the CBO, then I can get the exposure to that market or the segment of the market. So especially the investment houses or institutions like a provident fund, pension fund, or insurance companies, they are going for the high return. So they would like to get exposure into these type of products. So they tend to buy these type of products. The advantage is that they can get the exposure to a segment in the market. Otherwise, they cannot get the exposure. This is a good opportunity for them to get into this market. That's the advantage for investors. But with the risk, as I mentioned, there's no free lunch in the market, financial market. So you get high return with a high risk. So depending on the this asset type, the word that we use may be different. Whenever I say collateral debt obligations, it can be any of these debts. But if the issue is only backed by mortgages, then we call it CMOs, collateralized mortgage obligations. But generally we call asset-backed securities. So that can be any asset. That's why you can see collateralized bond obligations. So that this is issued based on the several types of bonds with different credit quality. So this issue is backed by set of bonds, maybe set of corporate bonds issued by different corporates with different credit ratings. So it's a diversified pool. So generally in the market, we assume when you have a diversified portfolio, risk is less. In the CMO, so we use the mortgage obligations to back the issue. Then we call it as a collateralized mortgage obligations. So then the risk is different. The risk in a credit card collection and the credit risk in a mortgages is different. In a mortgage, there's an asset that you can recover part of it, but in credit card collection, it is not. In a car loan or a vehicle loan, there can be that vehicle is kept as a collateral. So different products has different risk characteristics. Depending on that, the CBO, the CDO issued has different characteristics. If you pool them together, it will give you a completely different risk characteristics. So the thing is, investors, they should be able to identify what are the risks in investing in these structured products. We generally call those structured products or the securitized product. So it gives us a high return, but with a high risk. So that's the basic of CDOs. So if you have any questions, I think better if you can ask that now. Any questions?
Mr. Shanta, these are basically the securitized papers that operate in the market, no?
Yes, that's why these are securitized products. We call securitized products.
In other words, SPs.
Yes.
So in that example, there are different tranches, no, for depending on the risk.
Yes.
So ultimately, for the issuer, he will be issuing similar to something similar to a debenture. He'll be issuing a securitized product, no?
Yes, similar to a debenture, but with different tranches.
Tranches in the sense now, these securitized papers will also have coupon interest or whatever.
Yeah. Yes, in the debenture coupon is given, then it's fixed. It's a whole one bunch, no?
Yeah.
In this, there can be 2-3 set of securities. Say one is 10-year with 5% interest rate. Another one would be 10% with 8% interest rate, something like that. The 5% one will fall into the senior tranche. The 10% one would be the mezzanine tranche, or another 12% one would be into the equity tranche. The credit rating of the 5% would be AAA. The 10% one would be with a credit rating of AA or something like that.
Yeah. So now, for even for the senior equity category, still the person who is holding that will get a coupon interest, no? Coupon interest or whatever, no?
If the cash flow is adequate to pay the senior and mezzanine tranche, and if there's any remaining thing, yes,
Then only he'll get the coupon.
then only that's why we call it a waterfall method.
Okay, so in a worst case scenario, even the senior tranche will not get a coupon, no, at times.
Yes.
Okay, so
That's
unlike
what happened in 2008.
Okay, unlike debentures or commercial papers, here we can't guarantee the coupon interest that we get.
Even in debenture, in a way, no. Then it is a default for the whole debenture. But here, what would happen, depending on the seniority, some will get the coupon, some will not get. But in the worst case, nobody will get anything.
But the structuring of the specific security for the investor will be more or less similar to how the cash flows work for debentures and bonds or commercial papers, no? The structuring.
What do you mean by that?
In the sense, you might, this is a discounted product.
It can be, yes.
Yeah, and you might receive coupons every 6 months or 1 year. Likewise.
Yes. So whatever the issue,
yeah,
in the senior tranche, it will give mostly be or gives you the basic features of a fixed income or the fixed income security or what we call bond. That features will be there. Yes.
So when a corporate,
whether the principal is paid only on the maturity or whether the monthly cash flow will there be part payment of principal and the interest, would it be a combination? That everything would be in the covenant.
And if in case if we are not receiving a coupon, then it will be a negative effect to our P&L, no?
Yes.
Okay.
Mr. Nishanta, then when we think about the SPV, that SPV has sole right to selection of the assets from the issuer, no? That means whatever best out of all assets, they can select from the issuer.
It is there, but the knowledge on the assets, what is the depth that they have? That's a question.
Yes,
because they are not the original issuer or the originator.
Yes.
The bank, they knows the quality of the customers.
Yes.
SPV will have to do a analysis separately.
Yes, once they transfer whatever assets which is available with the issuer to the SPV, that means finally that issuer will remain bad quality assets sometimes, no?
What issuer means the SPV?
Not SPV, that originator. That means
originator is removing everything from their books.
No, actually that's right, that the asset portfolio, they will transfer whatever good assets to SPV because SPV is very concerned about the quality of the assets for securitization.
Not really. It won't happen. Not really. That depends on the because the SPV is also generally created by the same originator. So not necessarily the whole the best performing assets are transferred to the SPV.
But investors are very concerned about that, no?
Yes, now, but earlier it was not the case.
Yes, at the same time, when you transfer the assets from that means originator to SPV, that asset will remove from the balance sheet, no?
Yes. That's why your capital requirement goes down.
Yes, and at the same time, their ROI is also will go up, no?
Yes.
Right.
No, what they can do, they can create new assets.
Yes, they can create with that funds, no?
With funds, yes.
Right. When we think about the equity tranche, that means they are get the highest return because of the risk factor.
Yes.
Right. Then mezzanine
with the highest possible
highest risk and highest return. No?
Yes.
What is the main reason for equity tranche? That means there are investors who willing to get that risk in the market.
Maybe. Yes, there are investors to take high risk and high return. One thing is that, and the other thing, the bank, the originator itself may invest in that part, because to give the confidence and getting ready to absorb some losses. That's the main reason. And while creating that equity tranche, while you are passing that losses to equity tranche, you can attract or give some advantage to the senior tranche to improve the credit quality. Say if it is a collection of loan portfolio for individuals, you cannot get a high credit rating on the issue.
Yes.
So to get that, to get the better credit rating, they structure in the product in that manner. Say whatever the first 80% of the cash flow goes to the equity or something. So not to the equity, senior tranche, and things like that. Then the chance of getting the cash flow to the senior tranche is high. Even though the say 10% of the borrowers defaulted, there's a guarantee that senior tranche will get their payment. So then they will get that tranche can be rated at a higher level, while that loss is absorbed through the equity tranche. That's the concept behind it.
Yes, Mr. In the same time, any condition in this securitization, that means if any bad assets, that means if there is a loan that will transfer into past due or not paid, if there's any condition that that portion need to be refilled by the originator?
No.
That loss need to be absorbed by the investor.
Yes. At the time of transfer, that there can be the originator may not be able to transfer non-performing assets.
But the time being, there might be cases like that. No?
After that, yes.
Yes.
After that, you can't, or the SPV can't do anything, or the investors can't do anything.
That's why I think they keep a margin. That means if you get assets like 1.5 times, you will to give 100,000, you will take assets worth of 200,000. That
Yes,
condition might be there. No?
Yes. That's one of the method that used to reduce the risk over collateralization, and maybe having a reserve fund.
Yes.
So not only the full cash flow is paid out for different tranches. So once you pay the senior tranche, the rest pays used to pay the mezzanine tranche. Then allocate some fund to the reserve, and if there's any excess, pay to the equity tranche. That type of arrangements also, that depends on the agreements and how they structure the product. It's not the agreement, how they structure the product. Then it becomes the part of the agreement. Then the servicer, they have to consider all those things and decide what are the amounts to be paid to each and every tranche, and what is the amount to be put it into the reserves.
Any trustee will engage with this transaction?
Yes, that's another part. Yes.
Right.
They will make sure that the cash flows are distributed according to the covenants and the conditions given in that.
Once you transfer the asset base to the SPV, who is responsible for collecting the cash flows?
Servicer. Yes.
Right.
And meantime, there can be arrangements, say in a pool like this. So if the sum of the assets does not perform as per the requirement, that can be replaced with some new assets.
Right.
That provision also there. So there can be different variations, but what I explained is the basic concept of a.
It depends on the agreement, no?
Yes. It ultimately becomes as a part of the agreement, but that's how the SPV structured the product.
If
SPV decide what to do and how to
Yes. If replacement condition is there, I think there would not be any risk. No, that means that any
No.
deteriorated assets will be replaced by the originator. No.
Yes, yes, but still there can be, if everybody defaulted or something like that.
Yes.
Yes, that can be. And,
If
and,
there's a-
and one of the requirements may come from the insurance company or the credit rating. Credit rating would say, no, under this, if you structure the product this way, we cannot give more, the maximum credit rating that we can assign this. If you want higher rating, do this, something like that. Then based on that, they will structure the product.
Normally, before happen this, I think there is a high level of due diligence is going on, no, sir?
It should be, but not the case. That's not the case. That's what we experienced in 2008.
Right. As an example regarding the asset quality, that means if you securitize your lease portfolio, it can be segregated as land, the agriculture vehicle, 3-wheelers and 4-wheelers like that. No?
Yes, yes. Better if you can select from or diversify.
Diversify.
Not
That means
only a particular, say if the whole pool is from agriculture, then it's highly exposed to that, or concentration is high. If something goes wrong in that sector, the whole portfolio will collapse.
yes.
But if you have a diversified pool, then even though one sector is not performing well, other sectors will perform well. There can be negative correlations as well. When one is not doing well, other one is maybe doing much better. So that's why it's better to have a diversified pool, not only with the sector wise. In Sri Lanka, this may not matter, but in a large countries, geographical distribution also matters.
For the different tranches, who will decide the return factor? So that means for the equity.
SPV. Whenever they structure the product, they decide this is the coupon rate for the senior tranche, this is the coupon rate for the mezzanine tranche. Likewise.
Is it variable or fixed?
That can be varied.
Right. Normally, longer term assets would be bonds and debentures, no? And housing loans like that.
Yes. The asset pool would be, yes. It can be housing loan, or that means mortgages, as I mentioned or showed here.
In terms of assets and liability mismatches, I think that for the issuer, it's a good opportunity to match the any mismatches, no? Asset and liability mismatches. That means they can pool entire portfolio, short term and long term and medium term into securitization. That means they get in the
once they give out this to the SPV,
yes,
then there won't be any assets in the books, no?
Yes.
So this will go out. Yes. In that, it can be considered as a asset liability match, because you remove your long-term assets from your book.
Means you don't need to have any liabilities for the long-term assets, no?
May not be, yes.
Yes. Okay, thank you, sir.
Okay. Yes.
So in the 49th slide, that means in one tranche, there may be several assets which has safe
Yes.
investment.
Yes. So in a one contrast debt obligation, the cash flow would be from the safe investment or the less risky investment and mostly risky investments. So that's a bundle that they create. That's the basic concept.
Depending on how much you have safe investment, that can be divided into senior and
Yes.
maximum.
Yes.
So in that case, when we transfer those assets to the SPVs, the customers pays their dues to the SPVs.
No, the customers, they won't realize any, and they may keep paying to the bank, but the service provider, they will collect it from the bank and transfer that, or keep the records and transfer that funds.
These type of products are not available in Sri Lanka.
Asset-backed securities, there are few.
Is it allowed in by central bank for banks?
Yeah, there's no. I think no special restriction. Maybe you may have to get the approval.
I think, Mr. Nishant, in Sri Lankan context, not much engaging
Not
by
much.
the banks. Finance companies, they are engaging this.
They are having this, yes. At least there are 2-3 available in the market.
Yes.
Yes, not by the banks, finance companies. They have done.
So you are like essentially selling your debt like factoring, right?
Yeah, sort of, yes.
So probably the market isn't big enough for all the complications they're settling for factoring.
In Sri Lanka,
Yeah.
yes. No, even you can. Sri Lankan people cannot understand what is a bond.
Yeah, right.
That's the reality. Oh, no, frankly, so would you prefer to have a low interest rate or high interest rate environment?
So it depends whether you are like, if you want to earn money by lending, then you prefer a higher
But
interest.
yes, you earn money by lending. So
Then you will prefer a higher interest.
no, you earn 15%, say 20%. If the inflation is also 20%, what's the point of earning that?
Yeah, true.
When the interest rate is high, when the inflation is high, what should matter is the real rate of return.
Real, yeah.
So, so when you earn high interest, that means your cost of living also high. If the interest rate is low and the cost of living also low, the margin is then and you there's no thing like that. Only thing is, but however, whether it's high or low, it would be better to have a stable environment without having volatility. Then you know what to do.
Then
this.
you can make decisions here.
Make decisions easy. That's the basic. So how many of us have understood that? When the interest rate goes down, investors or the like pensioners or those who depends on that interest income, when the interest rate is high, what would happen to the investments? That means the real investment, those who wants to start a business or things like that.
Yeah,
Their cost of funds is high, then their out production cost is high, then the selling price is high. That is there.
Mr. Nishant, when SPV, whose responsibilities managing the SPV independently? Is it originator's responsibility or is there?
It's a separate entity.
Yes.
So that entity itself has to do that.
Yes,
there may be, depending on the markets, there may be regulatory requirements. Is it clear?
Yes.
Anything else?
Recovery functions and follow up with the customers and other things.
Generally, that's the job of the servicer.
Size
He gets the commission based on the collection
collection.
and the recovery as well. And if there's a default, do the liquidation process, that is also responsible, that part also responsible by the servicer.
To this transaction, Mr. Nishant, I think there might be lot of cost is involved in there for the operation part, no? As a commission and like that.
Yes, that is also there. Yes, but when the volume is high, even 1%, 0.5% would be enough. Everything is factored, and so the say the average interest or the income of the pool is 10%.
Yes.
There may be 1.5%, 2%, or depending on the market, goes for these things, and for the investors it may be 8% or 7%, something like that.
Whatever surplus amounts in the SP, we will transfer again to originator, no?
At the end, yes,
At the end, yes.
At the end, yes. Anything else?
If any liquidity crisis scenario for a bank or finance company, this is one of the method of getting some cushion, no?
By issuing, yes. If you can quickly do the structured product and transfer the assets to a SPV and get the fund, that would be, yes, it will work. But I don't know how quickly you can do this.
In customers' point of that means say that, no, that means if we say there is a mortgage property by a customer to bank, then bank will securitize it to the third party. Will that without any consent from the customer, that can bank do the securitization? That means that mortgage.
No, that again that can be catered through the agreement. So even though it transferred to the someone else, the customer has the obligation to pay to the bank.
Right,
So
that obligation is there, no? Yes.
Yeah.
That primary relationship in between that two parties.
Yes. They do this in such a way that the customer has the obligation to the bank. Then bank or the trustee monitors whether the bank has received all those funds, and bank transferred those to the SPV properly, the service provider, and that's what their role.
So if the bank has like removed everything from their books, can they still receive the payments on these?
Yes, why not? It's like you say you collect electricity bills and things like that.
Okay.
You collect it and pass it.
Just a payment.
Yes,
Okay.
yes.
You transfer it. And are these SPVs regulated in somewhere? Like,
I think it's a question, but I'm not sure about Sri Lankan context. Otherwise, yes, most of the markets, yes, there will be regulations. There are regulations.
okay. Thank you, sir.
So the next part is about synthetic CDO. So this is again without having an actual credit risk portfolio. Through credit default swaps, you can synthetically create a CDO. That is what we call a synthetic CDO. So you don't actually have that credit portfolio, but issuing credit default swaps, and then you can synthetically create CDOs. But this is very risky. Then again, there's no, as selling CDS, there's no limit. When the market is only 10 billion, you can issue 100 billion worth of CDOs. So that risk is there when you go for a synthetic product. Again, the synthetic CDOs are divided into tranches, and the lower tranche, that means equity tranche, provides the capital or the initial investment, and senior tranche may not have to make any investment either. So, and almost like in a CDO, even in the synthetic CDO, every tranche will get a payment based on the cash flows arising from the credit default swaps. When you write a credit default swaps, you get premiums. Based using those premiums, they will receive the payments. But if there's any loss occurs, then you have to make the meet the other pay out the buyers of the credit default. So that risk is there. So the loss, again, as mentioned, the lowest rated, that means equity tranche first absorb the loss or bear the loss and gradually moves up in the ladder. So
the payments come from the CDS commission or the
premium, yes.
So, but that is a one-off payment, right? Or do you like
every year? So you buy the CDS for a particular period. No, it may be 1 year.
Okay.
If you want to do it for the next day, then again you have to pay the
rollover.
Otherwise, you won't get that protection.
Yes. So in a credit event, the SPV or the
SPV has to pay back, or the whoever the synthetic CDO issuer has to compensate the CDS buyers.
Okay. Yeah.
That would be the investment, indeed.
As in?
That would be the sort of investment that they have to make. Because you are selling CDS, you collect premiums.
Yeah.
Whenever the default occurs, you have to pay for that
default.
Yes. So that's all about it. I think that's enough for you on that front. Any questions?
That synthetic CPO, I didn't understand. Can you explain again? Without having an asset, how can you do the
It's like, say, you are selling a credit default swap. If you can understand this credit default swap, by selling credit default swap, what do you assume? You assume the credit risk of the reference entity. When you sell the credit default swap, you collect the premium. But in the event that reference entity fail or the credit event occurs, you have to make the payment or the compensate the CDS buyer. So in a collateral debt obligations, what you have for an investor, you make payments depending on the cash flow that you receive from the from a one party. So that investor assumes that so by selling the CDS, you take the same thing. You assume the credit risk of that other party, but there's no direct link to that reference entity. You don't have you have not invested in that entity. So that's why we call it synthetic. You create an artificial exposure.
But even without having link, those products are available. Without
Yes,
having link,
yes,
okay.
yes, yes. So even in CDS, that's what I mentioned last week. Say a particular bank, Citibank is the reference entity. Say before 2008, Lehman Brothers, they might have issued CD. Say the Citibank has borrowed say $1 billion. Lehman Brothers, they can sell CDS for maybe 2 billion or 5 billion worth of CDS. Because Lehman, as the CDS issuer or the protection seller, assume Citi won't fail. They just want to collect the premium. So that is again synthetic or sort of leverage. More than the real market exposure, you have created CDS. The moment Citi failed, whoever the protection seller, assume Lehman, had to pay that instead of 1 billion, the Lehman had to pay say 5 billion. So that's the problem. Then through derivatives, you can leverage. You don't want to invest in the real asset, but you can synthetically get the exposure to that asset.
So the investor return for such investment should be very high.
Sorry, investor?
Return for such investment should be very high.
Yes. So that's what it says in the in synthetic CDOs, return is high. Extremely high, not high. Whenever it says extremely high, within bracket, extremely risk. So that's the other concept that our people won't understand. Say, if you get extremely high return on an investment, the risk is also high. On the other hand, if you get very cheap fund or very easy access to funds, again there will be a hidden cost. So without documentation or just by sending SMS, you get the loan, but the interest rate may be high, or their recovery method may be very aggressive. Those things can happen. So those are the hidden costs. Yes.
In options, so do we discuss that option brief? We don't discuss.
Option grade, we discussed. If I remember, we discussed delta.
Just only cumulative delta.
Sorry?
No, the delta we didn't discuss in the instance, that only the cumulative delta.
We discussed delta and the cumulative delta. That means what is the delta?
Until that
Delta for a
cumulative delta,
portfolio, and yes, we
until
discussed
that until that cumulative delta we discussed.
until
Cumulative delta we discussed.
yes.
There were some other problems.
It's not in this. It may be. Is it in the option 2?
It's option 2.
Now we discussed this. What is delta? We discussed those. Yes. We didn't discuss this. That's what you said. Yes, we didn't discuss this. If you want, I can discuss this.
If we have time, we can discuss.
So we have another about 45 minutes. So we can discuss this. So basically, what is gamma? Sorry, delta. What is delta?
Cumulative.
No. What is delta? Whether it's cumulative or not. What is delta?
The price change in relation to price change in premium. It's relation to change in price of the underlying asset.
What is the change in the option value or the premium for a 1 unit change in the price? So that is delta. And I mentioned, say when the spot price is 100, delta is say 0.2, but when the underlying price goes to 102, delta won't be 0.2. It is not fixed with the underlying asset. The delta, it's like duration. This is price of the underlying asset. This is the premium. So it's like, indeed, it's not exactly this way. However, so whatever the sensitivity here is different from the sensitivity here and the sensitivity there. So at different prices, delta changes. That means the slope of this curve changes, similar to duration. So the gamma is the change in delta. This is, how can I say, change in delta. That means sensitivity of delta to the price change of the underlying. That is gamma in simple. How the duration changes with the yield. Can you remember? When the yield increases, duration changes very slowly. But when the yield decreases, duration changes very fast. That convexity, that measures the convexity. The delta is, gamma is correspondence to that convexity. How the delta is sensitive to the change in the underlying asset price. Then the vega is the premium, sensitivity of the premium for what? Volatility. Volatility. V for V. So what happens if volatility increases? Premium. What's the relationship between volatility of the underlying asset and the premium? If volatility increases, premium.
Also increase.
Sorry?
Premium also increase.
Premium also increase irrespective of whether it's a put option or a call option. So, but how much? For an increase in one unit of volatility, what is the change in premium? It is measured by Vega. Then what is theta? T O. Can you guess? T4. What's the other factor?
Time, right?
Time. Exactly. So theta measures the sensitivity of the premium for change in time. Rho, that is the sensitivity for what? Risk-free rate. That means the interest rate. If the interest rate changes, what would be the impact on the premium? How sensitive the premium for a change in risk-free interest rate. So those are the option Greeks. Now can you tell me at which point gamma is highest? Is it for the in the money option, out of the money option, or at the money option? So as I mentioned, so I think now I have briefly described all those things and given in these. Gamma measures how delta changes with respect to movements of the price of the underlying. At the money. Why? For a small change in price, the option can go into in the money or out of the money is and it is highly sensitive. So the delta would change by a drastic amount. So at the money option has the high gamma, that means high sensitive delta, especially when it is very close to expiry, because it will decide whether the option expire at the money or in the money or out of the money. But when it is in the deep out of the money or in deep in the money, it doesn't really matter. It is 1-to-1. So the delta would remain as 1 irrespective of the price change. If price increase by 1, premium also will increase by 1 because intrinsic value increases by the exact amount. Time value does not give that much. So the change in delta is 0, or close to 0. So the small gamma will be reported for deep in the money or deep out of the money options. So as mentioned, when the spot price changes, delta changes, then the delta hedge won't work. based on the delta figure, whatever the hedge that we have done will not work because now the delta has changed. So our portfolio has to be rebalanced or do some adjustment. So gamma is used to do that correction, like in convexity. Because if we use duration, it is a linear approximation. But when the price or the yield of the yield is changed, duration changes, then our position changes. Then we need to do that correction. That's why we calculate the change in price considering the duration as well as the convexity. Likewise, here also in options, to maintain the hedge, we have to do that adjustment based on the gamma. So you can do this example in these 4 different prices, different deltas, and then what is the price movement is given. You can do this and try. In the Vega, as I mentioned, change in volatility, how the option price changes. But it always positive for long positions in both call and put. Why? Volatility increases, option price increases. So there's a positive relationship. If volatility decrease, option price also decrease. It's not the other way around, like in the yield and duration. If yield increase, price decrease. That's why we have duration negative. But here, volatility increases, option price increases, volatility decrease, option price decrease. So the sign of Vega is always positive. Again, at the money options, the Vega is high. That means sensitivity is high. And for long dates options as well. Compared to short maturity, high Vega. That means high sensitivity for volatility. So there are strategies where you can create an option portfolio. The value of the portfolio won't change just because of the price of the underlying changes. That is we call delta neutral. But if the volatility changes, you will make a loss of profit. So that's how you trade volatility. That is also can be done. Then the Vega is the measure of risk. So all these option Greeks can be used as risk measures for these options, not only options, even in some other products. These so therefore you may see in portfolios in risk measures as risk measures all these delta. Even in that sense, duration is considered as delta, theta, gamma, Vega, everything is computed. The concept is what is the change in the value for this variable. Delta is the change in value of your portfolio for the change in the underlying asset. Theta is for the change in value of your portfolio for the change in time. Vega is for the volatility, likewise. So theta is the sensitivity for the time. You may remember the time decay. Remember this graph. When it gets closer to the maturity, expiry, value of the option drastically goes down. With the time, value of the option decays. So that is we call time decay. This is a positive for the to whom? Seller of the option, and negative for the buyer of the option. So long calls will have a negative theta and short calls and puts have positive theta because they make money when times. So basically theta is high when the volatility is low or there are few days to expiration. Even for a longer maturity, if the volatility is low, then the volatility won't have a large impact on the price of the option. But then time matters. So the time will have a higher sensitivity. So therefore, when the volatility is low, theta is high, or when it very closer to maturity, then time factor matters. So therefore, theta is high. As I mentioned, rho is the last one, option Greek, that is measures the change in interest rates. Sensitivity of the option premium for the change in interest rates, because it's impacted on the cost of carry, as I explained. Whether you buy a call option or whether you buy the underlying asset, that have an impact on the cost of funding. To buy the asset, you have to invest the full amount. If the interest rate is high, funding cost is high. So you will tend to buy the call option instead of buying the underlying. So the premium of the call option will go high, but how sensitive? Depending on the product, or that means the underlying asset, the sensitivity may vary. So premium, we discuss this. This is sort of summary. This, don't worry about this. Don't worry about this one. So that's the basic introduction of these other Greeks. So remember, this is the only one that you cannot link to anything. What is this? This is the change in delta. Then V for volatility, T for time, R for rate, interest rate. That's how you should remember it. Anything? Any question? So definitely you should know what is the relationship between option premium and these factors. Gamma and delta related to underlying price of the underlying asset, spot price. Then the vega is for the volatility, theta is for the time, and R for the risk-free rate. Those are the main 4 factors that have an impact on the option premium. How sensitivity is the option premium for those factors are measured through these option Greeks. So for the underlying asset price, both delta and gamma is used. For the volatility, vega. For the time, theta. For the risk-free rate, rho. That's the summary. Any question?
slide 68, there is an example. It is not possible.
Is it 1 month 50 calls, premium is 2, delta is 0.45, price of XYZ is 48. What are you expect to calculate?
In the next slide, there's what are you profit dollars?
So assume price of XY moves up to 49. What is your profit or loss? Now the price is 48. Price of the underlying asset is 48. You have sold 50 calls at the strike. Sorry, the premium is 2. No need to worry about the strike here. The delta is given 0.45. What would happen? Price goes to 49. What is your obligation? Now you have sold 100 call options. Sorry, no. With the strike of 100, 50, sorry, yes, you have sold 100 options with the strike 50. That's what it says. This is number of options this is strike. My question is, what would happen if the underlying price moves from 48 to 49? What changes? What else other than this underlying asset price? What else changes?
The premium change.
Premium change. Would it go up or go down? All options, underlying price increases,
Goes up.
premium goes up. By how much?
Point 45.
Sorry?
Point
0.45. Why 0.45? It is delta.
1.
Delta tells you if the price increased by 1 unit, what would be the change in delta? It's a plus delta. So price increased by exactly $1. So premium should increase exactly by the amount of delta. So the premium will move to 2.45. Are you making money or are you losing?
Losing.
You are losing. Why?
No sold.
You have sold. What is the loss?
0.45 per one.
0.45 per one option. For 100 options,
45.
45 is the answer given. No. Okay. So what is your profit or loss? It's a loss of minus 45 dollars. What is your profit or loss if you have bought 45 of XYZ? What does it mean? You have bought 45 stocks of XYZ when the price was at 48. While you are selling these options, you bought 45 stocks. What would happen? When the price increases from 48 to 49, will you make a profit or loss on the stock? You have bought 45 stocks on XYZ when the price was at 48. Now the price moves to 49. Will you make a profit or loss? This is not option, nothing to do with option. You bought some stocks when the price is 48 and then now the price is 49. Whether you make a profit or loss?
Profit.
Make a profit. How much?
$1 per one.
$1 per one stock. How many shares that you bought? 45. It says assume that you bought 45. So then what is the profit on that? What's the total profit? On the stock only. On the stock only. Huh?
45.
45. So now assume you had that. So you sold 100 options and you bought 45 underlying asset. What is your net gain or loss? You had both positions. Sold call options, 100 call options, and bought 45 shares. Price moves from 48 to 49. What is your profit or loss?
No profit or loss.
So the net is 0. So that is what meant by delta hedge. So you created a short position on options. Then you get exposed to the market. If the market price goes up, you lose. To make it 0, you buy the same shares number of, or depending on the delta. So you can see that this 45 is delta into number of shares. Sorry, number of options that you sold. That's how you get this 45. When you sell 100 options, you buy 45 shares. If you buy 100 options, what do? If you want to make a delta hedge, once you buy options, you sell shares equal to 45. Then whatever the price fluctuation, there won't be any gain, loss or profit for you. That is the meaning of delta hedge. Having said that, I have to say this may not exactly same. You may not get the say exactly 0. Why? This may not be 45. Can you tell me any reason for that? The impact of gamma. That means the delta changes with the spot price changes. So 48 to 49, it's 1 unit. Yeah, that's true. But continuous when it comes to 48.1, 48.2, 48.5, likewise, the delta also changes. The premium may not be exactly 2.45. It can slightly deviate from this 245. Therefore, there can be a small profit or loss here. If you want to make it exactly 0, then you have to do that delta gamma, consider gamma and do that adjustment what we discussed. So don't worry about that, forget about it. This is how you create a delta hedge portfolio. This strategy, selling call with long underline this is called covered call. Covered call strategy, but it's not the hedge one, delta hedge one. So whenever you sell call options, say 50 call options, you buy 50 underlying asset. Then you are fully protected. But this is much more dynamic thing. When the price changes, delta changes, then the amount that you have to buy or sell would change. So assume instead of it's going up 48 to 49, this goes to 47. Then this will go down by 4 5. This is the portfolio of the shares will go down by $1. Now the delta may change 0.45 to something else. Then you have to buy or sell number of assets depending on the new delta. So therefore, this delta hedge is a dynamic process. Every day, at least every day, you have to rebalance your portfolio. Keep buying or selling underlying asset or options to match it, to bring it neutral. Shall we stop there?